You've clicked on this video because you're a beginner investor, so I'm going to give you a complete beginner's guide to investing. Use the timestamps in the description below to jump around this video should you need to. When I started to learn about investing, it was so overwhelming and it seemed like this thing that only the rich or the knowledgeable could actually do, but that is so not true. I had seen success with investing firsthand from my granddad, and I'd also heard lots of different people becoming financially free from investing. But I didn't even know where or how to buy these so-called stocks from. And I was finding it really hard to learn, and I think part of that is because lots of these resources about investing typically tend to be US based. So I kept hearing things about 401ks and Roth IRAs, and I was just thinking, could I even have one of these? Turns out I can't have one of those, but there is a UK equivalent that I'll talk about later. I have spent a good few years now trying to learn everything I can about personal finance and investing. So I wanted to make this video so that you guys at home who may be beginners will find this a lot less overwhelming and way more simple than I did.
And just quickly, I am not a qualified financial advisor, so please do your own research.
So, what is investing? Well, simply it's where you use your money to buy an asset, which is just something, and then hopefully that has the potential to make you money. You might be asking now, why invest? There are a lot of reasons why you may want to invest: to build wealth, to become financially free, to not have to keep relying on your 9-to-5 job, or just to set up your future. Oh, and also you may want to try and combat inflation and how your money is going to lose value over time. So you may want to hold that money somewhere else other than having it in a bank account or in cash. And also banks pay quite poor interest. Interest is the amount that a bank will pay you to hold your money with them. So you may want your money to start working for you more than it currently does, and investing can definitely help with this. Your money may go up holding it in a savings account with its little interest each year, but inflation is going to eat that up and more. But isn't it risky, like gambling? A lot of people who don't know much about investing or are looking to start investing are kind of worried about two main things. Firstly, the risk of losing all your money. And second, do they need to spend ages and ages learning? In terms of risk, it comes down to risk versus reward and deciding which type of investing style and which type of investments fit best with your personal risk appetite. In the media, you will also hear of people who A, got super rich from investing, right place, right time, or B, people that lost everything they had, which fair enough is enough to put anyone off of investing. I think many people who worry about the risk of investing are not really thinking about the risk of not investing and how leaving your money in just a savings account could lose value, as we discussed earlier. The bottom line here is investing is not trading and it's not gambling. It's for the long term. In terms of how much you need to learn before you start, well, it depends. The barrier to entry really doesn't need to be high, and you don't need to spend ages learning, especially if you invest in certain things. Whereas you probably will need to put some time and effort into learning, especially if you're going to start picking stocks. We'll get onto that soon. Okay, what can you actually invest in? Bonds, cryptocurrency, real estate, index funds, ETFs, mutual funds, stocks, just to name a few. And this is really confusing, right? Like, how are you ever meant to pick? Well, I think we can keep it really simple here and we'll just discuss stocks and funds. So let's do stocks first. A stock is an ownership of a company. So if you say,
I own Microsoft stock,
what you're actually saying is, I own a bit of Microsoft. You've probably heard of the word share as well, and stocks and shares as a collection of words. And to be honest, stocks and shares are used interchangeably. And as a beginner, I really wouldn't worry. But just for some context, share gives you more information about how much of a company you own. For example, you would say, I have 2 shares of Microsoft. But honestly, using either or works in many situations. So you could buy a stock, a share, whatever, in Apple, Tesla, or any public company really. But you can't buy stocks in private, not publicly traded companies. Annoying, I know, but it's just the way it is. Publicly traded means a company listed on a stock exchange, but let's not worry about that right now. Anyway, you could buy some of Apple, some of Tesla, some of Microsoft, and just call it a day. And as long as these companies go up in value over time, your money will as well. But what if you don't know what companies to actually invest in? Or perhaps you just want a buffet of different companies instead of just having 1, 3, or even 5 different companies. Well, you can actually buy funds. Funds are like a shopping trolley full of different stocks. And sometimes you'll even get some other assets like bonds thrown into. So you could buy just one fund, and within that one fund you may get hundreds or even thousands of different stocks. There are mutual funds, which are funds but they're actively managed by an investment manager for you. So quite literally there will be a person that decides what stocks make up your fund for you. And then you pay them to do that. And there are also index funds. These are again funds, so a collection of stocks, but this time they're passive. You don't have anyone managing and deciding for you. Instead, they just try to match the stock market. So for example, the S&P 500 and the FTSE 100, which are the 500 largest companies in America, so the likes of Google, Microsoft, Apple, Tesla, and so on, and then the top 100 companies in the UK, respectively. An index fund is a collection of different stocks, designed to mimic the performance of a financial market like the S&P 500. This can be really quite confusing, and it took me ages to get my head around and a lot of reading and watching YouTube videos. But I think the thing here is to note that index funds are passive. There's no one managing them for you, which in turn means they're cheap and less fees that you need to pay, which is really great for many people, but perhaps especially for beginners, because you may not actually want to commit too much money yet, or you may just not have a lot of money to commit to investing yet. Most people, including investing legends like Warren Buffett, will just advise you to put money into a popular index fund, do that every single month, and don't worry about anything else. And the great thing about index funds is not only the low cost of them, but also the diversification that you get. With index funds, you get to invest in loads of different companies, different stocks, so you get to represent all different industries, and also quite often you get to represent global companies in your index fund. And this means you are not reliant on just one company to do well. But of course, some people like to pick stocks and actually have a say in which company their money goes into. And a lot of people find it just fun to pick stocks. And there is this God complex as well, where a lot of people think they can get a better return than any fund can. By the way, you can totally invest in lots of different things. For example, I personally invest in cryptocurrency, funds, and in stocks. I don't want to overwhelm you, but there are also dividend stocks and funds. These are not too different from the stocks and the funds that we just discussed, but these ones will pay you to invest in them. And that's the only difference really. For example, Pfizer, the big global pharmaceutical company, or Legal & General, a not so known perhaps UK insurance company. These are dividend companies, meaning they will pay their shareholders, the people that invest in them, a percentage of their profits. So you may be thinking,
well, hang on a minute. I'm not stupid. Of course I'll invest in a stock or a fund that's going to pay me. Duh.
Well, it's not always that straightforward, so make sure you look at the pros and the cons of dividend investing first. So if I invest, how much am I going to make? Well, that is the golden question, and honestly, I don't know. If you invest in just one individual stock, then I really don't know, because I can't predict, just like anyone else, how well that company will do. Maybe they'll go up 40% over the next year, but maybe they'll go down 10% over the next 5 years. Who knows? And that, my friends, is why stock picking is hard. If you invest in an index fund, like the one that tracks the S&P 500, remember those largest 500 companies in the US, then the average yearly return would be 8%. So every year, on average, you would make 8% of what you put in. If I'm only getting 8% return a year, how am I going to be financially free? Well, my friends, compound interest, the eighth wonder of this world. And we need more wonders in this world really, because quite honestly, it's not a very nice place, and compound interest is quite lovely. Compound interest is the money you earn on your money, the interest on your interest. But I think compound interest in investing needs demonstrating rather than explaining. If you put £100 into an investment and every single year that investment returned you 10%, then after year one, you'd have £110. £100 from what you put in and £10 coming from that 10% interest. And in year two, you'd get 10% again, but this time you'd get it on the original amount and on the interest. So on £110, you would be getting £11 in interest, which means after year two, you'd have £122. And in year three, you'd have 10% on £122, giving you £134, and so on. So put in only £100 in 5 years' time, you'd have £165 or so, which is really not that bad. And if you were to plot this, you would see that over time, your money would be growing exponentially rather than linearly. And this only gets more powerful if you regularly add money to it and you leave it for long periods of time. For example, if you put £100 into an index fund that returned you on average 8% per year, and then you put monthly contributions of £100 in each month, and you did this for 30 years, after the 30 years are over, you would have over £151,000. And most of that is just coming from interest, which is not the money that you've actually put in. And that is so cool. The point here is that if you want success at this, you really do have to view it as a long-term thing. You can't really invest into these types of things and then withdraw your money 6 months later, because chances are those 6 months the market will perform badly and you will lose money. However, the general financial global market will go up over time, but there will always be recessions, crashes, and times when the market just isn't doing well. So it's really important to ride these times out and stick with it for the long term.
But when should I start? Is now a good time?
Well, the best time to start investing would have been last year. Actually, 5 years ago. But today's a better time than 6 months' time. So basically, just start as soon as possible. The saying goes, time in the market is better than time in the market. Right now is not a great time in the market. Things aren't performing very well and a lot of things are going down. However, some people may argue that this is the perfect time to start investing because everything is pretty much on sale. When people say things are on sale, by the way, in this context, it refers to the price of buying a stock or a fund. When the stock price, which is the value of the company, how much you need to pay to own a stock in that company, goes down, as they typically do when the economic market is trending down, it means that these companies are on sale. So if you buy them at this price, there's more potential to make money on them. It's just like if you were to go to a charity shop and see a really nice watch being sold for just £10, and you knew that that watch was worth at least £100, that would be a right sale, and the potential to make money there would be great. Well, it's the same idea when a stock is on sale. I think the most important thing to say here is start as soon as possible, be consistent, and don't worry too much about time in the market. You may also want to think about dollar or pound cost averaging. This is the idea of purchasing a stock at regular intervals, for example, every single month, regardless of its performance and its price. This way, naturally, sometimes you'll buy a stock at a higher price, sometimes at a lower price, and eventually, this will all average out. Personally, I just invest as and when I can, and I don't really take too much interest into trying to time the market.
Where can I invest? And what do I do about tax?
So maybe you're ready to start investing now, but how do you do that and where do you go to buy these investments? Do you go to Amazon or do you just go to your bank? This is where it gets interesting, I think, but the most important thing to say is always try to make your investments tax efficient. Let's keep your money away from those tax fairies. There are particular types of accounts that will actually protect your investments and your money from tax. In the UK, we have what is called an ISA, an individual savings account. In particular, a stocks and shares ISA, also known as an investment ISA. This is a type of account where you do not pay any tax for any money you hold within that account, any money you withdraw from that account, or any money made within that account. It's the best thing since sliced bread. There is a slight but here, and that is that there is a limit of how much money you can actually put into an ISA in one tax year, and it's £20,000. You can contribute £20,000 into this account, and you can do that every single year. If you put £10,000 into one of these ISAs every year for 3 years, then you'd have £30,000 plus whatever you make inside of this ISA, completely tax-free. If you want to invest more than £20,000 a year, you can do this, but it will have to be outside of your stocks and shares ISA, and it could be in a general investment account, but you would be taxed. So how does buying stocks or funds actually link with this ISA account that I'm speaking about? Well, you open a stocks and shares ISA with a provider, and then you invest in stocks or funds or whatever you want within that ISA account.
Right, I'm going to invest, but what provider should I go with?
Many providers offer ISAs. For example, your local bank probably does, but also loads of online platforms and institutions. Honestly, these days there are so many options and I would just be here all day. But the best provider is going to be the one that works for you and can provide you what you want to invest in. Sometimes you're going to get ones that are really cheap but their website sucks. Others, they're going to be really good website but they're really expensive. Honestly, it just depends what works for you. Some popular ones include Vanguard, Trading 212, Free Trade, but there are so many more out there, so you just need to find out what ones. I actually did a video that I'll link up here where I compared some different stocks and share ISA options when I was trying to decide who to go with. It's good to know that these options and these providers also depend on where you're located too. And it's worth noting that you can also change your provider if you want to. There is so much more I could say about investing because honestly, this is a topic that I just love, but I really don't want to make this overwhelming and I want this to be a one-stop hit for beginners. So hopefully you found this video helpful, and if you did, please share it with other beginner investors.
Thank you so much for watching this video. Please check out the other videos on this screen and don't forget to like and subscribe.